Welcome to Iron Financial. This is where we forge stronger portfolios by hammering out the absolute truth. Today, we're putting Cricut, that's ticker CRCT, right on the anvil. You know, their latest earnings report, it's a real puzzle, and it has Wall Street completely split down the middle. So, how in the world can a company with basically zero sales growth turn around and boost its profits by a staggering 22%? It just feels like a paradox, right? On one hand, you could be looking at the blueprint for an absolute profit fortress, but on the other, you might be seeing some serious cracks that could bring the whole structure down. So our job, right now, is to figure out if this company is built of solid steel or if it's just a hollow facade, ready to crumble. Okay, let's just dive right into the core of this. Look at this slide. This is the entire story in two numbers. On the left, full-year revenue. Dead flat. It's actually down 0.5% to $708.8 million. That's stagnation. And let's be honest, in this market, flat is the new down. But then you glance over to the right. Full-year net income, we're talking the bottom line, the real profit, is up a massive 22%. That is not a small beat. That is a complete blowout. To me, this looks like a case of just incredible operational strength. It's like a masterclass in turning stagnant sales into solid gold. Wait, hold on. A masterclass? I'm sorry, but I see a business that's shrinking. I see a company that fundamentally can't grow its sales, and so it's desperately cutting costs just to make the numbers look pretty. You're calling it operational strength. I'm calling it a warning flare. I mean, how can you possibly get excited about profits when the top-line revenue engine has completely stalled out on the side of the road? That's not strength. To me, that's a huge sign that the market for their main product might be totally saturated.
So yeah, that really brings us to the fundamental question we have to hammer out today. Where is the structural weakness here? Is it in that top line, like I suspect? Or is this profit story so incredibly strong that it just doesn't matter? We are going to put this company on the forge and see if it holds up under the heat. We're going to drill down layer by painful layer, starting with the most obvious problem, those sales numbers. Let's find out if Cricut is really building something that's made to last, or if it's all just, smoke and mirrors. Exactly. Let's start right there. Section 1, we're cracking open the top line. Look, you can't build a fortress without a solid plot of land, right? And in the world of business, that land is your revenue. So we need to understand precisely why it's flat and what that really means for the long-term integrity of this thing as an investment. We've got to look past that headline number and start breaking it down piece by piece. Is the entire business just stuck in the mud, or is there something else happening just beneath the surface? Now just look at how stark this is. It goes from $712.5 million to $708.8 million. Honestly, that's not even a decline. That's practically a rounding error. But for a company that's supposed to be in this high-growth, creative tech space, this is like slamming on the brakes. The whole pandemic-fueled boom in at-home crafting is officially done, and it looks like Cricut is hitting a serious wall. So this is the baseline reality. We have to accept this before we go any further. That top-line engine is non-growing, full stop. But, and this is a really crucial point, that flat number is actually hiding a pretty dramatic story. See, total revenue is made up of two very, very different businesses. As you can see right here, you've got products revenue on one side. That's the machines, the vinyl, the materials. That part of the business is actually shrinking. But then on the other side, you've got platform revenue. This is the juicy, high-margin subscriptions, the digital files people buy. That business is growing. So this isn't one stagnant company. It's really a tale of a legacy hardware business that's in decline and a modern recurring revenue software business that's on the rise. On the rise, come on. A 5% increase in platform revenue is hardly a rocket ship going to the moon. And it's perfectly offset by a 5% decline in the product's revenue. You cannot have one without the other. It's simple. People don't buy the high-margin subscription unless they first buy the low-margin machine. The product is the gateway to the platform. And if that gate is closing, if fewer people are buying the hardware that gets them into the whole ecosystem in the first place, then your platform growth has a ceiling. And believe me, it is approaching fast. This isn't some brilliant transition. It feels more like cannibalization. The only real bright spot on this entire slide is that 8% international growth. But that is nowhere near enough to carry the weight of a declining hardware business here at home. And look, you really don't have to take my word for it. This just says it all. The company's own CEO, Ashish Arora, said it himself, right there in the press release. We are disappointed in the lack of total company sales growth. I mean, when the person at the very top of the org chart tells you they're disappointed with sales, you should probably listen. They know there's a problem. They're basically telling the market, hey, there's a problem. The top line is weak, period. And that weakness is a major, major structural concern. Disappointed, yes, but panicked? No way. Of course, the CEO is disappointed with sales growth. I mean, that's literally his job. But you have to look at what they are doing. While everyone on Wall Street is getting completely fixated on the top-line challenge, management has been doing some serious heavy lifting somewhere else. They're busy forging a profit fortress. So for Section 2, we're going to ignore that noisy revenue story for a minute and focus on what the smart money is actually watching, the bottom line. And that's where they are building an absolute machine of profitability.
All right, let's just run through the evidence. We're going to do this rapid fire because honestly, the numbers just speak for themselves. First up, gross margin. It exploded. We're talking from 49.5% all the way up to 55.1% in a single year. That is a massive expansion, nearly 600 basis points. In today's inflationary environment, to expand your margins by that much, it tells you this company has immense pricing power and absolutely ruthless cost control. They are squeezing more and more profit from every single dollar of sales.
Next, that beautiful margin expansion flows directly down to operating income. Now, this is the profit from the core business operations, and it's up 26%, not 2.6%, 26%. So while revenue was flat on its back, the core profitability of the company literally shot up by more than a quarter. This is not some financial engineering trick. This is operational excellence. This is management doing its job and, frankly, doing it exceptionally well. And finally, the number that actually pays the bills. Net income. The bottom line. It's up 22% for the year, hitting $76.7 million. This right here is the ultimate proof. You can talk about stagnant sales all you want, but at the end of the day, this company is putting significantly more cold, hard cash in the bank than it did just 1 year ago. Profit is the bedrock of any sound investment, and on that front, Cricut is building on solid granite.
Granite? I don't know. I'm not so sure. Is this truly a fortress, or is it just a fresh coat of paint on a crumbling wall? Look, anybody can jack up prices and cut operating expenses to boost margins in the short term, but that is not a sustainable strategy if your customer base is unhappy, or even worse, if it's shrinking. Profitability that's built on a shrinking foundation, well, that's just a house of cards. So the crucial point we have to figure out is, what does that foundation actually look like? Are the users, the people who actually power this whole ecosystem, are they sticking around?
That is the right question to be asking. If the user base is collapsing, then your whole argument holds water. But if it's stable, or maybe even transforming, then that supports my case. So let's examine that foundation. Let's get into Section 3, the user base foundation. This is where we are going to stress test this entire structure, because the financial metrics, they're just an output. The user metrics, they're the input. Let's see if the numbers show a solid base or one that's starting to erode.
And there it is, right there. Look at that table. That is the smoking gun. My case rests right here. The top two lines are red, total active users, flat, maybe down a little bit, but then look at the next line, arguably the most important one on this whole chart, 90-day engaged users. These are supposed to be the core customers, the power users, the people who are really driving this platform. And that number is down 3%. Okay, it's not a total collapse, but it is a meaningful decline. The number of people frequently using their machines is shrinking. That is not a crack in the foundation. That's clear evidence of erosion.
Let me just hammer this point home, because this is absolutely critical. A 3% drop in your most engaged user base means that over 110,000 of your core customers just stopped using the product frequently over the last year. These are the people who buy the materials, the ones who evangelize the brand to their friends, the ones who are most likely to subscribe to the service. And they are becoming less active. You just cannot build a long-term growth story on a user base that is becoming less and less engaged with your core product. It's a fundamental contradiction.
You are cherry-picking the negative data, and you are completely ignoring the much more powerful, positive story on that very same table. Yes, some casual users might be dropping off, so what? But the highest value users, the most important ones, they're growing and they're paying more. Look at those bottom two lines again. Paid subscribers are up over 4%. And the platform ARPU, that's the average revenue per user, basically how much cash they generate from each person, that's up another 5%. They are getting more money from more of their best customers. That isn't erosion. That is a successful strategy to focus on profitability. It's the hallmark of a mature platform business, not a failing one.
Okay, fine. We can sit here and debate user metrics all day long. You see a glass half empty, I see a glass half full. But there is one part of a company's financial report that leaves absolutely no room for interpretation. It's the ultimate source of truth. It's the bedrock. And that is the balance sheet. So for our fourth and final section, let's look at the balance sheet bedrock. This, my friend, is where the argument ends, because these numbers are completely undeniable.
I'm going to deliver a 1-2 punch here that just completely settles the question of this company's financial health. The first punch is cash flow. In 2025, with flat revenue, Cricut generated over $200 million in cash from its operations. Think about that. This isn't some accounting profit. It's not an estimate. This is cold, hard cash flowing into the company's bank accounts. A business that generates that much cash is fundamentally healthy and, more importantly, durable.
And here it is, the knockout blow. How much debt is this company carrying to fund these operations and this incredible profitability? The answer is right there on the screen. Zero. A big, fat zero. Nothing. They have absolutely no debt. In a world of rising interest rates, where debt can absolutely crush a company, Cricut has completely insulated itself. It owes nothing to anyone. This is the very definition of a financial fortress.
So let's just put it all together. They ended the year with roughly $276 million in cash and marketable securities just sitting on the balance sheet and zero debt. This company isn't just built to withstand a storm, it is built to withstand a hurricane. It gives them immense stability and all the flexibility in the world to invest in new products, buy back stock, or even acquire a competitor without ever asking anyone for permission. I'll concede that, I have to. The balance sheet is a fortress, it's undeniable. But a fortress can also be a prison if you don't have a plan. Having a giant pile of cash is great, but it is not a strategy for growth. So what's the plan to deploy that capital to reignite the top line? That is the question they still haven't answered.
Which brings us right to our final section, the iron verdict. We've examined the top line, we've hammered on the profitability, we have stress-tested the user base, and we've absolutely confirmed the bedrock of the balance sheet. So now it is time to weigh all the evidence and deliver a clear, actionable conclusion. Let's lay out the bull case and the bear case side by side. My case is really simple. You have to focus on the steel frame of this business. You have massive, best-in-class gross margins at over 55%. You have powerful cash generation of $200 million a year. You have a fortress balance sheet with zero debt. And your highest value customers, the paid subscribers, are still growing. This is the solid core of a durable, cash-producing machine. And my case is that you simply cannot ignore the cracks in the facade. That steel frame is totally useless if the building is empty. You have stagnant total revenue. You have declining sales of the core products that get people in the door in the first place. You have shrinking engagement from your most active users. And most importantly, management has not yet articulated a clear, compelling catalyst for any future growth.
So you know what? I think we've actually arrived at a consensus here. The market has been treating Cricut like it's a high-growth tech stock, and it's been punishing it for not delivering that kind of growth. But maybe that's just the wrong way to look at this company. This is no longer a growth story. I agree completely. What this company has really become is an efficiency play. Cricut has proven, beyond any shadow of a doubt, that it can engineer incredible profitability and cash flow from its existing stable user base. I mean, they are masters of optimization. But the risk is glaring. An engine, no matter how efficient it is, cannot run forever without new fuel. And for them, that fuel is new user growth.
And that right there brings us to our final provocative question for every single investor watching this. This is the one thought you should take away from this whole explainer. The company has forged an incredibly efficient profit engine. That's a fact. But its original growth engine, the one built on selling new machines to new users, it's definitely showing signs of rust. So the question you have to ask yourself before you put your hard-earned capital to work is this. Can Cricut use its financial fortress and all its operational expertise to forge a completely new growth engine before that old one seizes up for good? The answer to that question will determine whether this stock is a deep value opportunity or a classic value trap. That's all for this edition of Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.